All right. I am here with Xandra Laskowski, and she is the founder and CEO at Osea Angel Investors. How's it going, Xandra?
Oh, it's great. It's great. I can't believe we're 6 weeks till the end of the year.
I
That's
know.
what happened.
Yeah, flew by, flew by. So I'm really excited to get into some of the tactical aspects of how you make investments, how you have the early conversations as an angel investor. But before we get to that, let's talk about your background. Like, how did you get started?
Yeah. So I came from a tech background, Silicon Valley, here in Orange County in Southern California. Worked at many different tech companies, and then retired in 1998. My husband works for a company called Broadcom. He was employee number 20. Our life changed very quickly in 1998, and then started our family office in 2008. So I've been managing that since then, and started angel investing in 2013. I had a few venture capital colleagues here in Orange County that started bringing me deal flow. And again, as a family office, we're risk averse. We don't want to lose money. So I had to really educate myself. But I came from a startup background. I worked for a startup company in Silicon Valley in the early 90s, the first removable disk drive. No one wanted it then. Now they have them everywhere. And my husband came from Broadcom. It was like 100-hour work weeks. I never saw him for 2 years. Just get the chip out. So we really did come from startup backgrounds. That's how we made our wealth. So just interesting enough, I really never thought to invest in startups until I started seeing some really quality deal flow coming from my syndication partners that I've been building here in Orange County. So that's kind of my journey into angel investing. And then in 2017, I started a women's group to teach women, you really connect, educate, and inspire them about this asset class. It's called Osea Angel Investors. We have 40 members nationwide. And we are also syndication partners with the Angel Capital Association. We're members, and we see a lot of deal flow from them as well. So that's been very gratifying because a lot of people don't really understand. They see Shark Tank or they see all these people that have startups and they just make it big, and most of them don't. You're going to lose your money pretty much. So you really need to understand the asset class, what you're getting into, and the risk.
Yeah, yeah, I like that. Coming from a startup background, investing in startups is sort of getting to see both sides
Yeah.
of the equation. And I really like that you mentioned deal flow. And I've talked to a few people about this, and that's kind of the king and queen of the space. When you're investing, you need to have consistent, strong deal flow. And I think that's really a kind of a fascinating tangent that we can go on for a bit. And I want to talk about first conversations at the beginning when you're vetting startups, we'll say, when they come to you and you're having the initial pitch conversation. We talked a little bit before we were recording, but what are some of the things that you discuss with startups first and foremost?
Sure. So all the companies we screen come from our syndication partners. Those are
Hmm.
angel groups and venture funds that we know, myself or my board member, we know them very well, and we do a lot of deals together. There's safety in numbers, so to speak. And our lead investors are our syndication partners. So they've already put the money in. It's going to be a much easier vetting process for us to pre-screen because we can make one phone call, look at the deal room, really understand the metrics. How have they been performing since you've made your initial investment? And where do you think the challenges are? We can have those pre-screened conversations with our syndication partners. Once we feel that it might be a fit, our board looks at it. There's a 7-point criteria that each company needs to meet. One, the lead investor is from someone we know, our syndication partner. The founder has to have built, scaled, and sold a company. I understand a lot of these new founders have not done that. But if they haven't, they're going to fail because they don't know what they're doing. Even the ones that have done that don't know what they're doing because everything changes. So if you haven't built, scaled, or sold a company, you need to have some adult supervision there. Your co-founder, an advisor, and I'm not talking like on a piece of paper, an advisor that's there, and we will know very quickly you have to have done that, or else have that team that has that background because it's really tough to scale a company. It doesn't matter what you're doing. You have to have metrics in place. That's very important to really understand your metrics, have the right ones in place because that's the way you're going to optimally scale this company. And it's all about the dollars. It goes all the way back to Let's make sure that the sales cycle is very quickly. We're shrinking it so we don't have to spend so much time on it. Let's make sure onboarding's great. Let's make sure that we have the retention. All of these metrics you have to be laser focused and understand. If you haven't built, scaled, or sold a company, you'll have no clue what metrics there are and how you report them and how you report them to your investors. So that is very important. Really understanding what are the early metrics there that you are looking at and managing to scale. 2 years of runway. It used to be 18 months. Now it's 2 years of runway in the bank to support the current burn. Typically, we'll see deals when they're at the very final age of their raise. We look at seed and bridge to A rounds only, and they'll have like the last 500K, the last little bit going. So they have the money in place and they're working towards profitability to be able to sustain themselves. So that's very, very important. So we're looking at late stage, early stage investments. And they have to really have that discussion already on where they're going to exit. I know we're going to talk about that a little bit later, but that's part of our pre-screen. Where do you see yourself exiting? At what time? What metrics are in place? What have you provided? What is your value proposition to that possible exit target? Have you been in touch with them? It could be through a fund, because a lot of the companies are in communication with venture fund arms of the sector that they're in. Many companies have their own venture arms. That's how they're going to stay lean and mean, by adding verticals really quickly to their companies. So really understanding where that's coming from. So that's kind of what we look at when we're looking at the factors. And sorry about my phone. My phone never rings, so now it's ringing. Yeah, but those are some of the factors. And they can be found on our website, oseaangelinvestors.com, OSEA.
Got it. I'll give it a second for the phone.
Yeah, sorry about that.
All good.
It never rings, like literally. Okay.
All right. Well, very cool. Very cool. So let's talk about the exit planning early on, because when you have those conversations, it is quite smart to have entrepreneurs come to you that have already gone through the exit once, twice, 3 times, however many times, because then you can have a map as to what the outcome would look like. Very traditionally, from my understanding, a lot of it's benchmarked to like IPOs that are going on in certain sectors where they price accordingly, and you kind of back in from the end, very, very end goal in mind. And when things aren't IPOing, companies aren't going public, deals get frozen. So I'm curious how that starts when you're talking to somebody that's gone through one exit. Let's say they come to you with a business and you really like them, you like the metrics, everything lines up. How do you look at the horizon for exiting? Is it a couple years out that they're saying? Because in startup land, that's like, a century if you're saying 5 years out. Yeah. So how do you look at the projections of that?
Well, they're in revenue, so that helps us. So they already are working towards those metrics to profitability. But then we're looking down the road, like if you're not already in contact with those possible exit targets, how are you going to get there? What introductions do you need? Like using your investors, to really understand that you're talking to the right people, getting it on their radar, and looking at their acquisitions. Maybe their acquisition target hasn't made an acquisition, but they're really interested in talking to you. Most of the time they have. That's why they're speaking to these strategic exit partners possibly. And then go do your homework on who have they acquired over the years, at what stage. But right now it's different, because everyone, after we've come out of this, the 2023 debacle of the banks imploding and things like that, and then the election's gone, I think now companies are flush with cash, and they want to add strategic verticals. Now we're kind of the M&A machines back on track. We have the engine's starting to go. So they are going to look back at the startup world in their sectors to see what kinds of verticals can we just plug and play here really quickly that strategically aligns with what we're trying to build. So understanding that as a founder, how would you strategically align with a possible takeout target? How would you give them value? Explain that to me, because that's going to be your sales pitch to them. Mm-hmm. Sometimes they're already being looked at, and they have, like we had one company we invested in, 123 Baby Box. And when I met the founder, she was an MBA student at UCI and had never started. She only had started this company actually in her garage, and she kept it going. And a year later, she had a $2 million acquisition offer from a strategic. And she called me and then she said, "Hey, Xandra, what should I do?" I said, "Look, if you sold this business, you only did 50 grand in sales. Right now, you should be very proud of yourself. This is incredible. This will change your life in many ways. but you're leaving money on the table, and you're leaving a lot of learning on the table. And she talked to many other people, and she didn't sell the company. That strategic came and invested $500,000 into her company and gave her access to their customers. So it's really different case by case, your market position, really understanding how am I in the market compared to my competition. There's a company we're going to fund this month, Gumi Group. We saw them a year ago, got a little bit of funding from us, but she had to pivot a little bit. All of her competition's gone. And it's in the health wellness platform, basically working with HR managers to be able to implement those HSA dollars that they can use for their insurance through yoga and cooking and all the programming. They make it easy for HR. So she was able to just last. And now she's on a run rate it's skyrocketing, but she really had to go, figure out her platform, make it more efficient to onboard and to train. And that's where she's at. All of the competition has fallen away. It's crazy. So it's market position. That's very, very important. So really the founder understanding who the strategics could be to show I should be on their radar. Let's look at who have you acquired over the years and at what stage and why, and how is that, how are we lined up to that, and really understanding your market position. If you have a very strong market position, then you're going to be very, very attractive to a possible acquisition.
And you mentioned valuation briefly there, but I want to dig into that. I want to figure out, we kind of benchmarked there to revenue, which is of course very smart. As an investor, you want to make sure that there's revenue coming in, but people listening to this, are using all different kinds of metrics when it comes to their business and any industry. Everybody's different, of course, but I'm curious to get your take on how to derive a valuation if an acquisition's on the table. How do you view that? And when you're having those early conversations with founders that are, gonna exit, what does that look like for you? And what is deriving the valuation kind of come from?
We typically invest in very, very conservative valuations at the seed stage level. And we see that is the trend moving forward to maybe they have to do one more Series A to get the dry powder to scale. But after that, we're very fortunate. We haven't seen any of our portfolio companies having to go past a Series A because they're in profitability and they're already in those strategic talks. Like right now, we have a few that we're hoping in the next 18 months to a year will be exiting. They're right there. They're speaking to their strategics. When it comes to valuation, of course, depending on your market position and what you're doing, an AI company that's got one lane and has, tons of users is going to have a different valuation than a small AI tech-enabled company that has their niche down, but the market is not as huge. So that would be, who knows? So that would be a 3x, a 10x, a 7x. I don't know. So we're working in that space. We don't have these big unicorns in our portfolio. We don't need those big unicorns because we have a lot of success with the smaller startups that are going to, you're doing 30 million in sales. You'll probably exit at 100 million. We're happy with that. So that's the playground we play in. But it really is, what is your value proposition? What are you going to bring to that acquirer that is going to bring them incremental sales to be able to, take your company and integrate it into theirs, and how soon to they're making profit, they're making money. You have to look at that as well, because that's how you negotiate. Well, we know that it'll be a pretty easy, seamless integration, hopefully, and you'll be off to the races in your next quarter to be able to add our line of business to your profitability and to those quarterly sales. So really understanding what value you're bringing at what stage they're purchasing you at will help you negotiate what that valuation looks like. Because if they come with a lowball offer, that's just a starting point. So really understand that. But look at your sectors. What is exiting in your sector? What are the valuations they're being purchased at? That information is out there. That'll help you kind of skew what their mindset is, because they're looking at your exits too. They're looking at the exits in your sector, and that's what they're going to come up with their acquisition offer. So it's kind of a dance that way.
Yeah. Yeah. I like that. Looking at what people are trading at, I think is a great metric to follow. And when it comes to timing, I think this is one that a lot of people talk about. You briefly mentioned that your sweet spot is seed, Series A, and people are exiting at that kind of Series A stage, which in my experience, that's when my company got acquired, around that A stage, because it's kind of like you've found product market fit, the kind of tank can just be filled with gas and moved at a rapid clip. So I'm curious as to the right timing when it comes to startups that you've invested in, because everybody's different. There's a lot of personal reasons that go into things with this beyond the numbers. And I think the example you said about selling for 2 million when she was like just out of college is a great example of somebody that could have life-changing finances, but then decides to take it on and go for it, which I appreciate. But what can you share around timing and when it's the right
It's
time?
different from company to company. Some companies, like we had one, unfortunately, have to liquidate and sell their IP because they were in the education space, which is so tough, such a tough space. And so they exited, but no one made any money. But but at least we got a little bit of something back. What was the timing on that? That was an emergency exit, and they found an acquirer for the IP and everything. Versus you're already in talks. You're in talks with those acquirers. You know what they want to see, and having that dance. But also, is the founder ready? I mean, and is the company ready? Is it, market positions there? You have your strategic alliances with all of your customers in place. You're scaling nicely. It's going to be a great target for that acquisition. Is the founder and team ready to sell? So every company is different. The companies we typically invest in, they're scaling. They're keeping their eyes on the road to do that, and making sure that their potential acquirers have a look of what they're doing. Because at some point they're going to come to the table and say, "Hey, I think we're ready here. Let's talk," or "We need to see this more." It just depends on the company, and it depends on why you are exiting at this point. So go back to your board, go back to your advisors, and really understand, what does that exit look like? Is it when we're in 3 or 4 years of profitability? Is it, before that, depending on their market position, they could help their acquirer, get into that lane and scale that way. It's different depending on the deal, on the timing.
And I wanted to kind of briefly touch on women-led startups, because I've talked a lot about this on the pod, about how I think it's less than 2% of funding goes to women-run companies. And a lot of solutions have been presented on this podcast. We've had some creative ideas, but I would love to get your take on how we get more capital in the hands of women founders that are listening to this, or just in general, what your macro view on that is.
Yeah. So I've been investing in since 2013, and my angel group, we invest in female founders primarily. And when we started in 2017, 13% of the companies we looked at were female founded, co-founded. In 2021, it was 95%. Now that is because the deal flow is coming from our syndication partners, and they're seeing these great founders. I think we need to create more women angels. That's what we're doing on our part, because we are much more, we're not looking at a gender lens. We're looking at the opportunity. Not that every, male-led VC looks at a gender lens. They just look at what they like, and then they're going to invest in that. We look at the whole enchilada. But it seems to me, when we see these amazing female founders, they know their numbers. They really understand what they're doing. They stay in their lane. They're speaking our language, and we are much more apt to put that early stage. We don't look, money in, because it's a great founder and it's a great solution, and they're running their company well. I wish, other funds and angels saw it the same way. We're getting there. It's not fast enough. I've been doing this since 2013. It's still 2%. That's ridiculous, but that's just the reality of it. If you have a great company and you do your homework and you really understand what it takes to scale, we're gonna see that, and hopefully that'll result in a check to you. But I don't know the answer to that. I really don't. I just know what we see are amazing companies. This year, I think 100% of the companies we screened were female founded, which was awesome. Nice. And we've invested in a few of those. So they're coming. They keep coming to us through our syndication partners. So that's a really good sign. So I think from what I see is there's opportunity there, but we stay laser focused to what our metrics are as well. We don't go beyond that. And a lot of companies don't fit that. When we see something promising, we also allow these early stage founders like 123 Baby Box come speak to our group, because if they come back when they've met all the metrics, there's a good chance we will fund them. So I don't know what the answer is here. I just know from what we see, We're seeing a lot more really great female-founded companies. There's an ecosystem out there that I'm involved in. I'm on the board of Women's Founder Network. It's a group here in Los Angeles, and they have a pitch event every year that's really done well. And most of those founders, if they win the pitch event or not, get exposure to the Southern California VC landscape, and they have a lot of success getting funding moving forward. So it's really be involved in your local ecosystem. Get with the SBDC. I mean, the SBDC, Small Business Development Center, which is funded by our federal government, helps startups. They help you with with trying to figure out funding, with trying to figure out your business plan, things like that. There's a lot of resources out there, and people say that, but they're hard to touch. Angel Capital Association is a great place to start because you can see all the members here in North America. And there's actually one article. It was written by a gentleman named Joshua Henderson. He wrote it originally in 2016. It's the only thing I know out there that's comprehensive, and it's a global ecosystem for female founders and startups. And it's a Medium. He wrote it on Medium. It's a Medium article, and it's from 2022. He just updated it. And there is a list of accelerators, funds, women's groups, like entrepreneurial women's groups that support each other, bring those ideas together, safety in numbers, and to learn together to go out to those funding sources. I don't know when it's going to change. I know a lot of really amazing women are working to change it. It's just going to take more time.
Yeah. Yeah. And I honestly think from everybody that I've talked to, dozens and dozens of extremely smart and just savvy women on the show that I've had on, I think what you described is exactly the solution of more investors that are women. And there's multiple ingredients that go into that. But I think the welcoming aspect of it, of a female founder coming in and pitching another woman, there is regardless of how we say it, there is like just a more comforting experience when you see eye to eye in that way. And it sounds odd, but for everybody listening that's heard me do multiple episodes about that, it is a really powerful ingredient here of how both of those pies grow when you have more women founders, more VCs and angels getting involved. It's like a supercharger for the amount of capital that can move through. And I believe that is the solution, honestly, based on all the conversations I've had, is just more investors. So that kind of takes us to the trends piece. I want to just touch on this before we get to the finale, which is what everybody's waiting for. But what kind of trends are female-led companies mainly jumping into right now, or have been very successful in over the last few years?
We've been seeing a lot of healthcare tech, just from over here, and what we've been investing in. We invested in an AI tech-enabled company that's in the healthcare sector. Gumi Group, we're going to be investing in. They're in the healthcare sector. Mm-hmm. So that's kind of, we've been seeing a lot of great companies and great positioning, stuck it out in that area, as well as some consumer brands. Like there's a company it's called Everywhere Apparel, and it's basically recycling materials out of Los Angeles. And what she does is she goes into large corporates like, I don't know, Abercrombie and Fitch, companies that Coach, that make lots of clothing and things like that. And they have this all this clothing they didn't sell. So they don't want that to end up in a landfill. So Everywhere comes over and helps them, take care of that, purchase the material and do things with it. So I think climate tech and ESG, I know ESG is a buzzword, but anything that helps with sustainability are other companies we're seeing with some great solutions there. And there's another company we looked at, Parrot Finance. They are a female-founded company, and what they're doing is a lot of the younger generation, my adult kids as well, my young adult kids, they get their investment advice from TikTok, and that's just the way it is, and it's not going away. They don't listen to me because they don't believe older people. So, but Parrot Finance is kind of tapping into that mindset and thoughtfully aligning those influencers that are making bets on the market here, and their followers to create education there, but also vetting those influencers to make sure those influencers are making those investments. They can't just go out there and say, "Hey, I'm doing it," and then they make an affiliate fee. No, 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 no. We need to make sure you're doing it because you're talking to all these Gen Zers and these millennials that are making investment decisions based on what you're seeing and what you're doing. So we're seeing a lot of innovation there. So it's kind of tech platforms for sure are the things that we love because we can understand how that scales and exits. And that sustainability aspect, we do like that. But those are the trends we're seeing.
Got it. Got it. Well, that takes us to the finale. Knowing what you know now, what would you tell yourself 10 years ago?
Listen to your advisors. When I wrote my first angel check, I had two great advisors. One came from private equity, and the other one was the largest private equity attorney here in Orange County, like managed funds and startups and things. And I didn't listen to them. I didn't have an investment thesis. So I just started writing these checks, believing in an idea, and lost some money really quickly. So I would tell myself, come up with an investment thesis, listen to your advisors.
Very nice. Very nice. Well, those are all the questions I have. Where can people learn more about what you're doing?
They can go to OC, which is OSEA, Angel Investors with an S.com. And they can reach out to me that way or on LinkedIn, Xandra Laskowski on LinkedIn. I typically, we have our emails that come in from our website. I batch them weekly. So if you reach out to me on LinkedIn, I'm going to get to you much faster.
Got it. Got it. Very cool. Well, wherever you guys are listening to this on iTunes or Spotify, the links that Xandra mentioned will be in the show notes. But thank you so much for coming on and sharing your wisdom.
Yeah, thank you. It was fun.